Hello, everyone, and thank you for joining us while we dive into our favorite topic, European data insights. I think we can all agree that the last few years have been volatile. No matter what you're investing in or where you're investing from, we finally have data to prove that in Europe. So Carta Europe recently released data insights based on over 1,100 funding rounds and over 500 primary rounds during a period from 2020 to the first half of 2024. I hope you all have had a chance to look through the article, but if not, we will link the article in the chat and we will be discussing it today. Before we dive in, we have received a handful of questions from the registration form that we have tried to incorporate into the conversation, and we also have the chat open and we'll be monitoring those as we go. So if you do have any questions, please send those over and we will hopefully get to them during our conversation. With that, I'm honored to be joined by experts in the space who have experienced the market shift firsthand and will be sharing their learnings and perspectives and shed some light on the venture market and how this data manifests in practice, and most importantly, how it impacts investment decisions. I'm very excited to introduce, I'm very excited to introduce our panelists. I'll kick it off with Andre.
Hey, Chloe. Thanks a lot for having me.
Yeah, and if you wouldn't mind just saying a little bit about yourself and your background, that would be great.
Sure. So I'm Andre. I'm a partner with Early Bird Venture Capital, pan-European VC firm, having been around in the market for 27 years, investing into the earliest stages. Obviously, very data-driven, have been working also with Carta for quite some while. So I'm on the investment side, but also lead our data-driven initiatives, have been writing also in the space and creating content under data-driven VC. And this conversation here will actually forge both of these areas of interest, European investing plus also data-driven. So really looking forward for this conversation.
Amazing, thank you. And James?
James Heath here from Dara 5. So we invest into venture in two different ways. One is to invest into funds, generally earlier stages, pre-seed to Series A as an LP. We invest into companies then through co-invests and directly from a little bit later stages, so sort of Series B and beyond. I'm the investment principal here, so kind of look after a lot of things on the investment side of the business. We invest in Europe and the US, so we can definitely kind of touch on some of the contrasts and perhaps some similarities today as well. And I myself love to be data driven as much as I can, and it's great that I guess in this asset class over the sort of last 5 years, more data has come to play that we can use, not just to analyze performance and kind of work out who is the best performing people in the space, but we can also start to use it, which Andre, I'm sure will touch a lot upon as well, about in the operation side of things. And it's great to kind of see how the asset class itself is becoming a lot more data driven.
Great. And Peter, our Carta data expert.
Hello, everyone. My name is Peter. I am the head of insights here at Carta, and I am a huge data nerd. So I think that's why I was invited. But happy to talk about how our data works, both for Europe and then also in larger part for the US. We can do some compare and contrasts and hopefully help founders or investors on the call understand what the current market looks like. But appreciate you all being here.
Great. And I'm Chloe. I'm based in the London office with Carta. I started with Carta in the US and spent some time in Asia and Singapore as we expanded into APAC. And now I'm in London, focused on fund services from fund formation to fund administration in Europe and UK, EU. So kind of broad there. All right, so let's dive in. We'll start with early stage and the idea of the new normal. So if you look at the data, we see that the size of pre-seed rounds are trending down by 8% year over year, but seed rounds, on the other hand, are up by 22%. However, the total deal volume is down by 54%, indicating that although there are fewer deals, the deals are much larger. So taking this into consideration, in the last 4 years, what is the biggest difference you've noticed when it comes to early stage rounds. I'll start with you, Andre, if you want to chat about that.
I think it's like I've been in early stage venture here in Europe now for about 6.5 years, and have seen the normal pre-COVID. Then, to my perspective, quite an anomaly in starting 2020, but then particularly 2021 and some early 2022. And then it was like correction, actually back to the old normal in a way. So this is like the overall view. I think there are a few perspectives that I want to mention about the European ecosystem. So Earlybird has been around for 27 years in the market. And I think back then there was very little capital supply, but more entrepreneurs that were seeking capital funding. So investors were in a very strong position to negotiate both their shareholding, but also terms in the round. And over the past decade specifically, you could see more funds evolving, number one. And with that, also a professionalization among venture capitalists over here in Europe. That being said, it was also that just like, I don't know, 7-8 years ago, it was quite common also for seed investors to get like shareholdings north of 20% initially. And it turned out, different to what people said in the past, that European companies can actually reach global scale. So back then it was a question mark if European companies can live up to their American or Asian counterparts in terms of exit valuation. And some of these companies have proven it right. So, for example, within Earlybird, we invested in UiPath in their seed round out of Romania, and the company did an IPO in 2021, just 6 years later after we invested at 33 billion. So it was quite clear that in Europe, there is this asymmetry between capital supply and demand from the entrepreneur's side, and an opportunity for investors to get in and comparably cheap get a very good shareholding in companies that can suddenly reach global levels when it comes to exit. So we could see many investors actually looking at Europe and the opportunity in Europe of getting in cheap in a way and getting this arbitrage of selling high on the other hand side. I think that as one dimension, and the second dimension, zero interest rate policy led to also more cheap capital in the market. So existing funds in the ecosystem were also suddenly able to raise larger funds. So if you look at the funds, say pre-2020 and the funds in 2020 and 2021 particularly, if you combine them, there are many GPs who suddenly doubled their fund size. And it might be because of their great performance in the past, but I think that's not an explanation for the average suddenly increasing. So we could see, on the one hand side, a big opportunity in Europe to buy low entry prices and sell at a higher exit price, also in not like too long time distance. And second level, you could see more funds being raised, which then eventually, and many people have seen that anecdotally, many American multi-stage firms coming over to Europe. So you name it, like the Sequoias, Lightspeeds, IVPs, and so on of this world, who opened up offices specifically in 2021 and 2022 in London, coming over to Europe and identifying this opportunity. So the European market also became more competitive, and for investors, this seemed for short as the new normal. So the question was like, how do you get into these rounds? And suddenly there was more capital supply than historically, but still a similar kind of opportunity in terms of companies, which then led to prices increasing and this kind of inflation. So I think this is the background of what happened in the years prior to COVID and also the peak of the market. And now if we look also at the numbers that you reflected in the report, came back down to like the actual normal in a way. So meaning what's the impact on round sizes, meaning what is the impact on time to raise subsequent round and so on and so forth. And I think to break it down, my interpretation also from anecdotal evidence and also your data is that it became more clear cut. So those opportunities that are still like very hot, that can raise larger rounds also in shorter periods of time between rounds. But for the majority of the market, it became more difficult to raise like between 2022 and now.
Andre, have you seen a change in the behavior of bigger American funds in Europe? Are they still as willing as they were a couple of years ago to involve themselves in rounds? Have some of them sort of taken themselves off the board? I know probably we don't have great data on this, but just anecdotally, what does it feel like in the ecosystem?
For sure, like very, very clearly. I think the commitment for Europe back then was very strong. I think they hired, like there were different strategies. Some hired local people on the ground, new to the firm. Some were some brought over more experienced people with more firm tenure, but new to the European landscape. Some went for a hybrid approach, but you could see a strong commitment. And I think for some of these funds, like typically if you open up new in geography, you typically go with like stuff that is quite downside protected. So you will not do like the first investments, which are insanely risky, that you might write off soon thereafter. So these funds came over starting with a good balanced portfolio, but also took some crazy risks. However, there were also some other firms, specifically crossover funds, that did incredibly risky and also highly priced investments that they needed to correct soon thereafter or even completely write off. So I think these firms either completely pulled out of Europe and also some of the other international activities, or significantly more conservative today than they were in the past.